Right, good morning. Today is September 2nd. Why was the economy so much more stable between the mid 1980s and the mid 2000s? Lots of research has been done on this question. There is a there is quite a bit of evidence that monetary policy played a role in creating better stability. In particular, even though workers' efforts to bring down inflation in the early 1980s led to a deep recession and a lot of pain in the short term, there was a payoff. The payoff was an economy that was much more stable, with low, stable inflation, more stable monetary policy, and more confidence on the part of its people and households, and that contributed very significantly to broader stability. Remember that Friedman pointed out that there was no long term trade off between inflation and unemployment. One could not permanently lower unemployment by keeping inflation a little higher. That is true, but in a different sense, low and stable inflation over a long period makes an economy more stable and supports healthy growth and productivity and economic activity. So, low inflation is a very good thing, and the reduction in inflation that occurred in the 1980s was really a global phenomenon. A lot of countries had inflation problems in the 1980s, but all around the world, even developing countries, brought down their inflation rates quite considerably, and that has been a positive for economic growth and stability since the mid 1980s. Not all of the great moderation was caused by monetary policy. There are other factors, no doubt, played a role. One is general structural change in the economy. An example would be that over time, firms have learned how to manage their inventories much more effectively. The practice of so called just in time inventory management is a practice in which instead of having large stocks of inventory on hand, firms acquire inputs only when they need them for production. Not having large stocks of inventories on hand reduces an important source of fluctuations in the economy because if demand slows down and you have a big inventory, then you do not do any more production for quite a while until you run down that inventory. Improved management of inventories is just an example. I could cite many others of better business practices and other factors in the economy that made things more stable. And it may also be the case that there was just better luck. We had fewer oil price shocks and other things happening, and that too may have contributed to the great moderation. But as figures 10 and 11 showed, there was quite a striking change in the way the economy operated after the mid 1980s. Another aspect of the Great Moderation is that there were not any big damaging financial crises in the United States. There was a stock market crash in 1987, but it did not do much damage. A more significant event was the boom and bust in the dot-com stocks in the late 1990s, and that touched off a mild recession in 2001. But one of the inferences people seemed more stable, took away, sorry, from the Great Moderation was not only was the economy more stable, but the financial system seemed more stable as well. As a result, financial stability policies got de-emphasized to some extent during this period. Let's turn now to the prelude to the financial crisis. One of the key events that led ultimately to the recent crisis was a big increase in in house prices. Figure 12 shows prices of existing single-family homes, where January 2000 is indexed to be 100. From the late 1990s until early 2006, house prices across the country increased by about 130%. You can see that line going straight up, a very sharp increase in home prices. And as I will discuss, at the same time that was happening, or perhaps a little later in the process, the lending standards for new mortgages to buy homes were deteriorating. Now, clearly, a big part of what was happening to create the housing bubble or the increase in housing prices was psychology. After all, the late 1990s was a period with a lot of optimism about tech stocks, and the stock market more generally. And some of that optimism, no doubt, spilled over into the housing market. So there was an increasing sense that house prices would keep rising and that housing was a can't lose investment. I lived in California for a while earlier than this, but during a period when house prices were rising and everybody talked about at cocktail parties was, what's your house worth now and how much money are you making on your home? It made working seem rather unnecessary because all you had to do was keep checking the real estate listings. So there was a lot of excitement and enthusiasm about the fact that house prices were going up and making everybody rich. At the same time that this was happening, the standards for underwriting new mortgages were getting worse and worse, which in turn was bringing more and more people into the housing market and pushing up prices even further. Let's talk a bit about mortgage quality. Prior to the early 2000s, home buyers were typically asked to make a significant down payment of 10%, 15%, maybe 20% of the home price. And they had to document their finances, their income, their assets, and so on in great detail to persuade the bank to make them a loan, which in turn cases might be 4 or 5 times their annual salary. Unfortunately, as house prices rose, many lenders began to offer mortgages to less qualified borrowers, so-called non-prime mortgages. These mortgages often required little or no down payment and little or no documentation. Essentially, mortgage lenders were moving further down the credit spectrum, lending to more and more people whose credit was less than stellar. You can see this in a number of different ways. Figure 13a shows the percentage of percentage of mortgage originations, that is new mortgage created, that were non-prime, subprime, or Art A, or some other lower quality mortgage. You can see that the very sharp increase, particularly in the middle of the 2000s and 2006. Almost one-third of all mortgages that were originated were non-prime. Figure 13b shows another indicator of the deterioration of mortgage quality, the percentage of non-prime loans with low or no documentation. If you think about it, this is rather perverse. If you are going to make a loan to somebody whose credit is shaky, who does not have a down payment and whose FICO score is low, and so on, one would think you would want to ask them even more questions about their income and their prospects. But in fact, it went the other way. And as you can see, by 2007, 60% of non-prime loans and 60% of non-prime loans had little or no documentation of the creditworthiness of the borrower. So there was clearly an ongoing deterioration of mortgage quality. This situation could not go for forever. Figure 14 shows the debt service ratio. As house prices went up and up and up, the share of borrowers' incomes being spent on their monthly mortgage payments went up. As you can see, eventually, mortgage payments became quite a large share of personal disposable income, finally reaching the point that the cost of home ownership was high enough that it began finally to dampen the demand for new houses. The debt service ratio collapsed after that, basically because interest rates came down. But the main point here is that high payments on mortgages finally meant that there were no longer new home purchases. And so the bubble burst and house prices fell. Figure 15 shows home prices. You can see the sharp increase from the late 1990s up until about 2006. But from 2006 until today, house prices have fallen more than 30%. So there has been a very sharp decline in home prices across the country. Right, that's a sad story.